If the markets drop 20% tomorrow, wouldn't it help to have a part of your portfolio that doesn't react to those swings? In a world of constant market moves and headlines, having a portion that stays steady by design brings balance. As wealth grows, priorities shift. It's no longer just about growth, it's about managing risk and keeping your plan tax efficient. Market volatility, rising rates, and the need for steady income can pull your strategy in different directions. Yet, one tool often gets overlooked, and that's the fixed rate annuity. Fixed annuities are not for everyone, and they're not designed to replace all of your investments, but they can add stability, defer taxes, and provide balance within a diversified plan, all backed by the insurance company's claims paying ability. In this video, I'm going to explain how fixed rate annuities work, why they sometimes make sense even for high net worth individuals, and the key considerations before you make a decision. Hi, I'm David Millington, certified financial planner professional and president of Puzzle Wealth Solutions. I spent over 2 decades helping individuals and families build personalized financial strategies to work towards growing and preserving their wealth. So if you're nearing retirement and want to explore how tools like fixed annuities could fit into a personalized, tax-efficient plan, book a Zoom meeting with me using the link in the description below. And if you find this type of content helpful, please like this video and subscribe so you don't miss future retirement planning insights. Okay, let's go. Part 1, understanding fixed annuities. A fixed rate annuity is an insurance product designed to provide a guaranteed compounding interest rate for a specified period of time. For high net worth individuals, the appeal often comes down to 4 core benefits. Benefit 1 is principal protection. Unlike investments directly tied to the stock market, a fixed annuity's value does not fluctuate with daily market movements. Your initial premium is backed by the issuing insurance company and may be returned to you under the terms of the contract, subject to contract rules and the claims paying ability of the issuer. That is assuming that you follow the withdrawal rules as well. This protection can be attractive for individuals who want part of their wealth insulated from market volatility, especially during their retirement. The second benefit, predictable growth. During the guarantee period, typically 2 to 10 years, interest is credited at a fixed rate, making it easy to forecast growth. While fixed annuities typically won't match the long-term growth potential of equities, they can play an important role in stabilizing returns within a diversified portfolio. Benefit 3 is tax deferral. Interest earned inside a fixed annuity is not taxed until you withdraw it. So for high income earners or retirees in a high tax bracket, deferring taxes can help keep current year taxable income lower and provide you with more control over when and how those taxes are paid. This can be especially useful if you anticipate moving into a lower bracket later on in retirement, allowing the withdrawals to be timed out more efficiently as part of an overall tax strategy. The fourth benefit is an optional income stream. Many fixed annuities allow you to convert the accumulated value into a series of guaranteed income payments, but you can also exit the annuity, hopefully beyond any surrender charges, and take payment of your principal amount plus all of that accumulated and deferred income. No need to annuitize in that situation. In this scenario, your annuity value accrues interest during the contract term and then is paid out in a lump sum upon surrender, subject to contract provisions. But no, unlike a money market, annuities are insurance products and carry different features and risks. Money markets, the interest is usually paid out over time, but with an annuity, a fixed rate annuity, it's paid out all at once when you surrender the policy. So for these reasons, the annuity isn't paying income along the way. And there is some credit risk. So for all of that, you should expect a higher yield than a money market. So why do high net worth clients sometimes overlook fixed rate annuities? Some investors dismiss them because they focus solely on higher return investments, or they assume that annuities carry high internal fees. In reality, fixed annuities can serve as a safe harbor for a portion of your wealth, helping balance overall portfolio risk while offering tax advantages. Benefits that can be just as relevant for a multi-million-dollar portfolio as for a smaller one. Also, once you review the expense structure on fixed rate annuities, you will likely find a whole different fee experience from other types of annuities. Now that we've covered what fixed annuities are and why they're often overlooked, let's talk about how high net worth clients may choose to incorporate them into their portfolios. So that takes us to part 2, strategic uses for high net worth clients. Fixed annuities are not intended to replace a well-diversified strategy. Instead, they can serve as a stabilizing component in a broader plan. So let's look at different uses. Use number 1, stability in a diversified portfolio. For investors whose portfolios are heavily weighted towards market-based assets like stocks or real estate, a fixed annuity can serve as a counterbalance. By allocating a portion of wealth to a fixed annuity, you create a segment of your portfolio that is shielded from market swings to help smooth overall returns. The second use, tax efficiency. Tax deferral can be particularly useful for high net worth investors who hold fixed income assets in taxable accounts. Moving those interest-bearing assets into a fixed annuity allows the earnings to grow without immediate taxation. This not only helps manage current year tax liability, but it also provides flexibility in determining when and how to take taxable distributions. Use number 3, supporting legacy goals. Some clients use fixed rate annuities to ensure that certain assets are preserved for a spouse or for their heirs. While fixed annuities are not estate planning tools, their predictable nature can support a broader legacy plan by freeing up other assets for long-term growth or inheritance. So before deciding if a fixed annuity fits your situation, there are a few key considerations to weigh. That leads us to part 3, things to consider before you buy. Even though fixed annuities can be beneficial, they are not a one-size-fits-all. Here are some considerations. Number 1, time horizon. Fixed annuities generally work best when you can commit funds for the entire guarantee period, which can be as short as 2 years or as long as 10. So if you anticipate needing these funds sooner than that, a fixed annuity may not be the right vehicles. Early withdrawals often come with surrender charges and may incur a 10% federal tax penalty if taken before age 59 and a half in a taxable account. The second consideration, issuer strength. The guarantees in a fixed annuity are only backed by the issuing insurance company, so the financial strength of that company matters. Remember to review ratings from independent agencies such as AM Best, Moody's, or Standard & Poor's to help assess the company's stability. Consideration number 3, the interest rate environment. Rates for fixed annuities are influenced by overall interest rate conditions. Locking in a rate when rates are relatively high can be appealing, but the term you choose should align with your liquidity needs, along with your investment outlook. The fourth consideration, look into the contract details and options. Each annuity contract will differ and can differ in features, fees, and payout options. Some include riders for additional benefits, but those usually come at an extra cost. Make sure these align with your specific goals before adding them into the mix. So with those considerations in mind, who tends to benefit the most from fixed rate annuities? Well, it varies. 1, risk-adverse investors with large portfolios. If you already have substantial exposure to growth-oriented assets, carving out a portion for a fixed annuity can help manage volatility while maintaining income stability. The second, high-income retirees seeking tax deferral. Those in higher tax brackets may appreciate the ability to defer taxes on interest earnings until they choose to withdraw it. A third group, individuals planning for specific future expenses. If you know you'll need a fixed amount of money at a certain time, for example, a property purchase, a family gift, or healthcare costs, a fixed annuity can provide a predictable value at maturity. So let's wrap this all up. Fixed annuities are most effective when used as part of a broader, well-coordinated plan. They work best alongside investments, retirement accounts, and estate strategies, not just in isolation. So if you want to understand how fixed rate annuities work, along with other strategies and how they can be part of your overall financial plan, please book a Zoom meeting with me using the link in the description below. At Puzzle Wealth Solutions, we specialize in helping high net worth individuals plan more confidently for things like healthcare, taxes, and income with personalized strategies that go beyond the basics. So if you found this video valuable, please like it and subscribe to the channel for more retirement planning insights. So until next time, remember, stay informed, stay proactive, and take control of your retirement.